There's two ways to look at it. There's fundamentals and technicals. The chart looks like long term it wants to go to 10,000.
Yeah.
And then I ask myself, okay, what are the fundamentals that get us there? And the next 5 years are going to be tumultuous. We have a lot of cross currents.
Where's the high price for gold? Probably $8,000 an ounce. I would be thinking, I think I better sell now at that sort of level, which is a 2x from here, double. Yeah, but silver, you look at silver, and it could easily go to $100 an ounce. And again, there's old pilots and bold pilots, but not many old bold pilots.
Former BlackRock portfolio manager Edward Dowd and market analyst Clem Chambers outlined why the coming 5 years may redefine precious metals pricing. Dowd notes that long-term technical structures in gold now stretch toward the $10,000 region, a target that only becomes realistic when paired with the extraordinary fundamental turbulence he expects ahead. Sharp monetary shifts, policy volatility, and global liquidity stress. Within that landscape, he argues that an $8,000 gold price represents a rational upside marker, the level at which long-term holders may finally consider trimming. Chambers adds that silver's torque remains unmatched. While gold may double from here, silver's asymmetric structure allows it to lurch toward $100 far more quickly when investor psychology flips. In markets shaped by fear, leverage, and tightening supply, silver remains the metal where bold moves deliver the most significant rewards. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Metals are pricing in a couple things. Gold became money again recently when the Basel III went through, at least in the U.S. banks. It's been going on across the globe. They made gold tier one capital again. We all know that we're coming to the end of a grand cycle, and the leaders of the world know this too. Again, it's not a gloom and doom statement. This is just reality. There's going to be a new monetary system at some point. Mm-hmm. And it's anyone's guess whether it's, next year or 10 years away, but we're heading there. We know that gold's going to be part of the system. Central banks are acquiring gold. Tether is acquiring gold, the stable coin. We see, and China has a voracious bid for gold, and they have their own issues. They hit a demographic wall in 2020, and their internal consumption is plummeting. It's just demographics. So they need to export more, and they need to depreciate their currency over time. The leaders and the smart people in that country that have all the wealth know this, so they have a voracious appetite for gold. So there's a demand and just a bid for gold. And also gold is also pricing in, the kind of the end of the super global sovereign debt bubble. We have problems in Japan. So gold is pricing in a fiat money crisis coming. I don't think it's the U.S. dollar anytime soon. I think, again, the U.S. dollar is going to rise into the midterms. That's our call. And so gold is a safety trade. It's a demand trade. It's a global sovereign credit trade. So there's a lot of reasons to own gold, in my humble opinion. There's two ways to look at it. There's fundamentals and technicals. The chart looks like long term it wants to go to 10,000.
Yeah.
And then I ask myself, okay, what are the fundamentals that get us there? And the next 5 years are going to be tumultuous. We have a lot of cross currents. We have a lot of problems demographically, and demographics are destiny. Europe is a demographic disaster. China is a demographic disaster. Japan and South Korea. So this and as you go into these kind of demographic disasters with all this debt, there has to be a release valve, and those release valves have always been currencies. And right now, the Bank of Japan is the first one to get into trouble. They are now they have the Hobbesian choice of defending their currency or defending the yen carry trade. And that's where we are. So it should be interesting to see what happens. There was a yen carry trade scare last August. They were able to manage their way through that. I'm sure behind the scenes, they got a lot of help from the U.S. and other central banks. So it's going to be interesting to see what happens with the Bank of Japan. That can blow up at any moment. Trying to predict when it happens is anyone's bet, but that certainly bears watching. And that would create a cascading effect across the globe if that were to happen.
Traditionally, silver is the fast horse in precious metals, but gold has gone on a run because it's very strategic in international stress. But of course, everybody sees gold. And as somebody posted on one of my videos, I'm thinking of buying copper bars and zinc bars. I can't afford gold, which of course is incorrect. Just because you can't buy a lump that big doesn't mean you can't buy a little piece. And, gold has got expensive, and gold has got expensive because governments are buying it. And, Wall Street and the market makers can't control governments. They can mess around with private investors, and they can, muck around with retail because they've got more clout. But when governments start to buy this stuff, they have to get out of the way, and they can't go shorting it and trying to manipulate the price, because if China wants to buy it by the ton every other day of the week, it's going to buy it by the ton, and it's going to expect to be delivered. So, the people in Wall Street who are super smart, you might not like them, but they're not dumb, get out of the way of that. Just let the demand and supply do its thing. And, just take the spread and let them go, no messing around. So gold runs, and then retail, which is a silver buyer. And by retail, I mean us, not companies, not governments, retail, normal people in the streets. They go, okay, gold a bit expensive. I'll buy silver. And retail is a juggernaut. It's an absolute juggernaut. It was funny today because somebody said, would you do some work for me? And, I laughed. I said, well, you can pay me in gold. You can pay me for that sovereign. And then I looked at the price of sovereigns, and it had gone up from where I thought it was. I've got a lot of sovereigns and a lot of gold, but, I don't really necessarily track this stuff. It's going up. I don't need to sweat the price 5 times a day. It's just going where it's going to go. And, the price of a sovereign has got, I thought it was about 500, isn't it? It's 800. And, that shows you how much it's moved. And, where's the high price for gold? Probably, $8,000 an ounce. I would be thinking, I think I better sell now at that sort of level, which is a 2x from here, double. Yeah. But silver, you look at silver, and it could easily go to $100 an ounce. And again, there's old pilots and bold pilots, but not many bold pilots. I'm an old pilot, and I'm not very bold these days. And at, $80, $90, I'll be thinking about leaving. But the number that I keep thinking about is that they make 3,200 tons of gold every year. They make 25,000 tons of silver every year. That's only 8 times. Yeah. So, if that ratio of 80 to 1, which it likes to seem to hang around at 100 to 1 when it's out of fashion, could easily go down to 40 to 1, and gold could easily double. So that's a quadruple. So from here, you could be looking at 150, 160. That's a stretch, a big stretch, but I don't think 80 is a stretch at all. And I don't think 100 is, 100 is getting a little spicy. So retail sees it, and they see a big old coin. And in fact, I was at the gold messe from Saw Financial a few weeks ago, and they gave me a 1 ounce silver round with their logo printed on it. And I thought, it's a nice thing. It's a nice thing. You can buy a bar, whatever, 1,000 ounces, okay, 40 grand, but it's a big old, 1,000 ounces is a lot of ounces. It's a big lump. And, you can get big lumps of silver, whereas you need a lot of money to have a big lump of gold. So that's why retail likes it. But retail has, let's just say, not quite so much nuance. That's the new word for it. It doesn't have so much nuance when it comes to price. And, B2B will never queue around the corner for an asset, but retail will. So, as the fast horse, silver has got really strong upside potential. And you've seen that it's broken out, whereas gold, platinum, palladium, and some other assets are still in a tight range, waiting for the news to come from the Fed that they're going to be dropping interest rates, waiting to work out what's next. They're actually poised to make a decision. The market is whether it should go the next leg or whether it's right at this sort of equilibrium price. Well, silver's gone through the equilibrium price. That was about $50 or $48. It's now 56 or 57 or whatever it is right now. So it's already run ahead of all the other precious metals, and literally it's run ahead. So the call is that the signal for gold, platinum, palladium to suddenly take a jump up, or has silver just, jumped off the starting blocks before the starting gun has gone off?
Edward Dowd and Clem Chambers recently discussed how precious metals are now reflecting the pressures of a global monetary transition, with Basel III elevating gold to Tier 1 status and central banks accelerating their accumulation, gold is increasingly treated as core collateral rather than a speculative asset. Both analysts argue that aging demographics, extreme debt loads, and weakening sovereign credibility are pushing nations toward currency resets, with gold positioned as the stabilizing anchor. Chambers notes that while gold may ultimately gravitate toward the $8,000 to $10,000 range, silver remains the torque play, already breaking past equilibrium pricing and potentially advancing far ahead of other metals. Retail demand, industrial tightness, and mining constraints all amplify that momentum, making silver the fast horse in the next phase of the cycle. Let's get into the interview.
There have been tremendous runs in gold and silver. And typically at these types of really rapid price moves, you want, I wouldn't be putting new money to work in gold and silver if I hadn't already purchased some. But if I'm a holder, and I bought well, I'm not worried. I'm holding because I do think gold and silver, rather than go down 50% like they did in the great financial crisis, I think they might go down a little bit and consolidate for maybe 6 to 12 months to 2 years and then reassert their price dominance into 2030. So I'm more in the camp that gold and silver need to consolidate. And that would be healthy, actually, if we see a consolidation pattern. And that wouldn't bother me at all. If there's a credit crisis and a Lehman type moment, Bank of Japan, everything gets sold. And if gold were to go down 20, 30, 40%, I'd be buying it hand over fist. I think gold is something you just want to continually stack when it pulls back. And I wouldn't be levered to gold. I wouldn't own, gold futures. I mean, it's a long-term investment. So silver is very interesting right now. I think, the silver gold ratio is repricing at the moment. Silver had to play catch up. It's doing that. There's also physical, supply demands going on. The CME supposedly went down because of coolant issues a couple of weeks ago, but some intrepid financial analysts figured out that there was a physical delivery issue that had to be taken care of, and we're going to see more and more of that as time goes on. There seems to be a voracious appetite for silver from a monetary standpoint and a industrial demand standpoint.
If that was the reason that silver really went on a run and was as why it's where it is today, then I would be bearish. I mean, servers blow up. Cloudflare blew up a few weeks ago and took half the internet down with it. Oh, it can't happen. It's redundant and it's distributed and no, bang, down it goes. Yeah. Oh, we've got 3 sites and we've got magic technology that stops this happening. And nobody plugged the magic technology in and the guy who was meant to switch it on was away and it's misconfigured. Bang, down it goes. And, it can never happen. We've spent millions making sure it can't happen. Bang, down it goes. So, it's just complex systems. We have no single point of failure apart from the one we didn't know we had. Oh, bang, down it goes. And, as somebody that's been in this space for best part of 40 years almost, time and time again, it happens. Really back in the day, I had a set of servers in Wall Street, and Wall Street had a server farm, as you might imagine. Back in the day when server farms were, you could conceive of their size. Whereas now it's like, half a county size. And they had, like, you got all your servers and all your racks and blah, blah, blah. And then you've got generators, and then you've got batteries. So power goes out. Someone sticks a backhoe through a power cable outside or whatever. There's a power strike, lightning storm, whatever. Down it goes. Generators go and generate electricity for you. What could be better? Well, maybe those generators, maybe they won't work. So if they don't work, there's batteries, and that's got like a day's supply of power to this thing on batteries, car batteries, lead acid batteries, whatever. So someone switches electricity off. I don't know. Somebody, threw the wrong switch. There was a thunderstorm. Anyway, electricity goes. Generators go. Whoop. No generators. Okay. Well, at least there's the batteries. Oh, no, they're all flat. Nobody made sure they were charged. Down it went for a, best part of half a day. And I've had that a few times. One time there was a magic box of reconfiguring all the power. If the power went down, it would go clickety clack clack, and that would be that. And clickety clickety clack, if that wasn't, and clickety clack. Nobody configured the box. It wasn't configured. Nobody knew how to configure the box. They flew an engineer in from Canada to configure the box to London. Unfortunately, it went down on a Friday night when the markets were closed, and by Sunday night, the guy managed to get off the plane at Heathrow, get there and gone, go. And it all came back. So, it's quite capable. It's just It happens all the time. I used to run a financial website with data, and I think the London Stock Exchange went down 3 or 4 times in 10 years. But they always go down when the market gets hot. And the reason they go down when the market gets hot is because the servers get hot. Hey, we've got a system. It can take 25,000 orders per nanosecond. Yes. And we've tested it once. We did. Yes, we did. Oh, here comes half our amount. Bang. Oh, we thought about the burr. Oh, but that switch wasn't on, and that was, and it overheated, and then Fred was away, and la 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 la. So when we said 20,000, it still can, and it still may, but please don't send that along. So it happens, and so there'll be a big .com crash was an example that the London Stock Exchange will go down. 2008. They couldn't cope with the order flow. The equipment had never seen it, and of course, when you're doing, 50 silver contracts a minute. Suddenly you're doing 50,000. Oh, bang, down go the servers. Oh, we didn't realize, our load balancer didn't load balance, and the Fred didn't Fred, and this, and then there's a fuse, but others, boom, boom. Time and time again. Time and time again. It will always happen. Cloudflare a few weeks ago. That is a global billion-dollar infrastructure provider. That is what they do. Boom, down it went.
Recent market action shows that gold and silver have surged through powerful technical phases, reflecting both structural stress and a shift toward tangible assets. Analysts note that after such rapid moves, a cooling period or sideways consolidation would be healthy rather than concerning, especially as long-term forces still favor higher prices into the end of the decade. If a liquidity shock or credit event hits, similar to past systemic breaks, precious metals could temporarily decline, but strong hands view that as an opportunity to accumulate. Silver's volatility, combined with tightening physical supply, continues to amplify its upside potential, while gold remains the long-duration anchor during global uncertainty. As markets adapt to increasing order flow, delivery demands, and pressure on exchanges, the broader trend still supports precious metals leadership throughout the next cycle. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.